In November 2022, one of the largest crypto exchanges in the world, FTX, collapsed, taking down several crypto businesses with it. Interestingly, financial pandemics caused by individuals like this is nothing new. In fact, there have been several more like it. Today, we will examine the largest corporate scandals in recent history. Stay until the end where we discuss several instances of capitalism gone wrong. Our last corporate scandal will definitely surprise you. Number 7. Wells Fargo. We start our exploration with Wells Fargo, an American banking corporation that committed the unimaginable. In 2016, investigators alleged the company of opening millions of fake accounts and credit cards in customers' identities without their consent and knowledge. Further investigations and employee leaks revealed that employees were incentivized to meet sales quotas, leading them to create over 3.5 million ghost accounts to meet those numbers. This revelation fanned the flames of public mistrust in the finance sector. Moreover, Wells Fargo lost nearly $185 billion in market capitalization, while the other banks' stocks suffered blows. This period saw Wells Fargo face nearly $3 billion in fines and settlements to aggrieved parties. Number 6. Enron. Founded in 1985, Enron was an American energy services company that quickly became a multinational corporation barely 15 years after its launch. In 2001, however, the company declared bankruptcy, motivating probes into its financial history and accounting practices. These fraudulent practices involve making confusing financial reports to misrepresent its loss, inflate its profits, and report debt as sales. They also opened shell companies to handle assets and risk so they could deceive regulators and investors about their true financial health. Besides the profound losses, global markets suffered because of Enron's bankruptcy. The scandal cost company investors about $70 billion. It also led to the downfall of Arthur Andersen, a large auditing firm that partnered with Enron to fabricate audits while serving as Enron's auditor. In the end, however, Enron's case led to the positive adoption of the Sarbanes-Oxley Act, a stricter set of financial reporting rules that served to curb future incidents like this. Its aftermath also helped introduce new penalties against defrauding shareholders and fabricating financial reports. Number 5. Theranos. Another notable scandal involves Elizabeth Holmes and her medical technology company, Theranos. Founded in 2003, the company set out to reinvent the medical industry by offering quick, reliable, and affordable blood test kits. Furthermore, they claimed the technology was highly efficient and needed tiny finger blood as opposed to the regular practice of drawing blood from veins. However, Theranos' accurate test kits, which they said could detect over 200 conditions from cholesterol to cancer, hadn't been peer tested within relevant medical communities. But Holmes misinformed buyers and investors about their product's efficacy even though her results had never been demonstrated. Then the scandal broke in 2015 and led to Theranos' eventual collapse in 2018. After facing a sales ban on the blood testing unit, the Centers for Medicare and Medicaid Services released reports criticizing Theranos and its testing facilities. This unfortunately led to Walgreens and Safeway backing out of their multi-million-dollar contracts with Theranos. And according to Forbes, Holmes saw her 50% Theranos stake crash from $4.5 billion to nothing. In its aftermath, Theranos' closure and corrupt practices cost the global market a heavy sum. Investors who had funded over $700 million into the company lost millions more as the company's stock value plummeted in the subsequent months. Now, former boyfriend of Holmes and Theranos president, Sunny Balwani, faces 11 years and 3 months behind bars, while Holmes appeals her case out of prison, despite also being sentenced to 11 years and 3 months in jail. Number 4. Wirecard. Next up is the Wirecard accounting scandal. Wirecard was a German financial services company and payment processor whose brand has become synonymous with financial malpractice. Long story short, whistleblower reports and investigations by Financial Times journalists accused the company of false reporting and money laundering. Allegedly, Wirecard's executives for several years had inflated sales figures and masked debt while also accounting for over $2.3 billion, which didn't exist. Given FT's reputation, these reports sent Wirecard shares falling and led to waning investor confidence. After finally succumbing to pressures to clear their name, Wirecard hired KPMG, an independent auditor, to audit the numerous allegations. By April 2020, KPMG cited a lack of sufficient paperwork as the reason it couldn't address Wirecard's allegations. Expectedly, this sent the company's stock down by 26%. Furthermore, KPMG's statement came just 2 months after another auditor, Ernst & Young, said Wirecard's representative had tried to deceive them by documenting an unprovable $2.3 billion in its financial reports for a quarter of the previous year. After a pointless search in 2 Philippine banks, Wirecard shyly announced the sum may have never existed and blamed it on unclear balance sheet accounting. Then on June 23, Wirecard filed for insolvency, and a month later, German authorities began investigations into potential money laundering. By July 16, the former head of a Dubai-based Wirecard subsidiary was arrested and shortly after confessed to involvement in a multi-billion-dollar fraud. Since then, Marcus Braun, former Wirecard CEO, has been arrested and faces fraud and accounting manipulation charges. The impact of Wirecard's scandal reportedly cost its shareholders over $5 billion, while also causing thousands to lose their jobs. Moreover, it negatively impacted global markets, with Germany's DAX index losing billions of dollars. At number 3, we have Lehman Brothers. Lehman Brothers was a colossal investment bank in the US that operated for over 150 years. They offered various services to their global audience, like trading, underwriting, and asset management. But in 2008, business took a turn for the worse. For context, the recession of 2008 was a damning global economic crisis originating in the US due to the housing market crash. Before the crash, Lehman Brothers, among other financial companies, took large risks by dispersing loans to high-risk borrowers with poor credit scores, aka subprime borrowers. Furthermore, Lehman hid their losses and debts through tricky but creative accounting malpractices that misled investors and regulators. Then, in 2008, to Wall Street's surprise, Lehman Brothers filed for bankruptcy with $619 billion in debt, marking the largest bankruptcy in US history. Unfortunately, Lehman Brothers' scandal and unethical dealings sent huge blows to the US and global markets. Its ripple effect also resulted in the foreclosures of many more financial institutions worldwide. This eventually led to the global recession, which saw multiple economies crash and regress and suffer for years. It was one of the most severe financial crises since the Great Depression of the 1930s. Number 2, FTX. As the largest collapse in crypto's short history, we couldn't dare leave out FTX out of our list. Founded in 2019 by Sam Bankman-Fried and Gary Wang, FTX grew to $2 billion in daily trading volume by 2021 and effectively became the second largest crypto exchange by volume in less than half a decade. But over 10 days in 2022, FTX crashed following CoinDesk's report of the possible leverage and solvency issues. Simply put, CoinDesk raised concerns over FTX assets potentially being unable to fulfill their financial obligations, like long-term debt and customer payouts. Furthermore, it disclosed that Alameda Research, FTX's sister company, had a $5 billion stake in FTT, while having its entire investment foundation there too. Mind you, FTT is FTX's native token, which is neither a fiat currency nor a crypto coin like Bitcoin and Ethereum. So when news about solvency issues within the company became public, it sent shockwaves of fear down the spines of traders and investors, especially as Sam Bankman-Fried's company kept its solvency private. On November 6th, Binance, the largest crypto exchange globally, announced it would be selling 23 million FTT tokens, its entire stake, which would roughly measure up to $530 million. This move sparked a chain reaction that motivated wary investors and token holders to discard their FTT. To FTX's surprise, customer withdrawals soared to a record high of $6 billion in 3 days. Less than 48 hours later, FTX publicly acknowledged its liquidity crisis and admitted to financial mishaps within the company. The next 2 days saw SBF appeal to venture capitalists for a bailout, but sadly his attempts bore no fruit until Binance unexpectedly offered to buy out its top competitor's non-US business, and FTX's hope lit up yet again. Until the unexpected happened again. This time, Binance on November 9th backed out of the deal, claiming they had done their due diligence and found concerns of customer funds mismanagement. With FTX's optimism squashed, the Bahamas-based project saw its assets in the country frozen by its government the day after Binance's backout. By November 11th, SBF stepped down, and FTX filed for bankruptcy. Acclaimed bankruptcy specialist John Ray, who for decades has offered structuring services to bankrupt companies, was announced as the new CEO upon a court appointment. Since then, the Bahamas has seized control over FTX's assets kept there, arrested SBF, and extradited the disgraced CEO to the US. But he has successfully been released on a hefty $250 million bond, the largest in history. Although the former CEO will face about 12 charges of fraud and money laundering by October 2023. Number 1. Volkswagen. In 2015, Volkswagen was caught cheating diesel tests to bypass accepted emission standards. Now you probably think Volkswagen aced its tests by bribing regulatory authorities and testing personnel. If not, how else could they tamper with the test results? Well, that's what we thought too. But after several investigations and probes put out, Volkswagen installed sophisticated software into millions of diesel cars that could detect when a car was being tested and reduce emissions to meet industry standards. Moreover, the most terrifying detail from this case was that without the software being active, Volkswagen's cars emitted 40 times the amount of pollutants. Yes, you heard right. Each car would emit 40 times the amount of diesel pollutants on regular no-test days. As expected, company CEO Martin Winterkorn resigned shortly after, and the company paid billions of dollars in fines and settlements. In the end, instead of denying wrongdoing like some other scandals on our list, Volkswagen's board decided to come clean and accept their crimes. This allowed the automaker to get away through vehicle owners' compensations and customer returns of the diesel cars. Looking back, Volkswagen's case highlights just how inventive greedy corporations can become when profits and green charts are at stake. We hope you've learned a thing or two about unethical business practices and the need for strict and unwavering regulatory oversight. If you want to see how the Netherlands rules the world, then this video will tell you all about it. And if you have a scam you'd like to share, don't hesitate and tell us about it in the comments. Thanks, and see you next time.